Ladies and gentlemen, welcome to Fintech Fridays. It's a little bit different. However, SoFi is the main topic of conversation. And in today's video podcast, available on YouTube, we have the great and powerful Roy Crossroads. Roy, how you doing?
Good. It's been a full week.
Yes, it has.
Fintech names reporting.
We also have the great and powerful Tevis, fun of investing.
Hi.
Tevis, how are you?
I'm doing good, man.
And last but not least, definitely not least, we have the mob boss himself, the mafioso, Stephen Fiorillo, Dividend Streams. How you doing? Stephen.
What?
How you doing?
Great. How are you?
I'm doing great, brother. I know that you've had a great week. You're holding on to SoFi. You've got Block. You've got what else did you have that reported this week?
Block.
You're a happy camper.
How's that Block doing, Steve?
It's a great Christmas present for Roy.
Dude, you're making fun of Joby. Joby's looking like a star next to Block.
Joby is looking like a star next to Block.
If you recall, I said multiple times then, I said I would have preferred Joby over Block. So, and you know what I think of Joby.
You weren't wrong.
Yeah, it's Jack. Like, I know we'll get into SoFi here in just a second, but like that really is the craziest thing about it, because I do not hate Block as a company, and I actually think if in a hypothetical world, Steve, where instead of PayPal, Block was looking for a CEO, if they had brought over Alex Chris, Block would be significantly ahead of where they are as a business and also maybe as a stock. I don't know. We'll see. But like I thought they were ahead of PayPal in a lot of ways. They just had a pretty mediocre CEO to terrible CEO. And yeah, he's terrible.
Well, it doesn't help when you completely miss that drastically on your numbers. Like, it does not help.
Yeah.
I mean, all the analyst estimates were grossly off. Everything was off. I mean, we'll see.
For what? Sorry.
Block.
We'll see. But what does we'll see mean? You're sticking it out?
Yeah, I gotta buy more.
Oh.
Gotta buy more.
Yeah, I got dollar cost average, and then once I get back to even or close to even, I'll sell it.
That's a gambler if I've ever seen one.
Well, the question is, do you think it goes lower from here? I think it doesn't.
You probably would have thought that at 70, though.
I probably would have thought that 70.
Yeah, to be fair, I mean, do we think that their earnings are going to fall into negatives, right?
No, not even with the lawsuits.
Yeah, so I don't know. I don't think it's going to continue to fall. If it continues to fall from here, I might look to take position. I don't really do well on recovery stocks, but you know, I don't necessarily think that this is a company that is fearing bankruptcy or some sort of harmed brand or even anything like this. It's just bad execution.
And if you listen to the earnings call, I listened to about 10 minutes of it, and then I normally just do transcripts for companies like that, but I had some time. They were hesitant. They were unsure. They sounded uncertain. They didn't quite dodge questions, but like you could hear it like in whatever segment that I was listening to, the point where you have Yangus, and I might be saying his name wrong. Like, he actually had tweeted and noted it. I'm like, yeah, that's what I'm thinking. I was like, this is my first time actually listening to earnings call. So I was like, I don't know if this is typical or not, but that is a management team that has no idea what they're actually doing. Jack has put a plan on board, but that plan shifts a lot, and the execution, like you said, it's not there. So the problem with Block really is this: they have a lot of good things going for them potentially, but the execution has not been there. And for it to be a turnaround, they would have to get rid of Jack and probably some other folks from the C-suite as well, do what PayPal did. But I actually think that Block is, and I think Brad Friedman had noted on this too, like has opened itself up to an activist investor coming in and saying, okay, we are going to come in, maybe Elliot, and we're going to come in and we are going to grab control of this company and get rid of Jack and get rid of who we need to in the C-suite and get things focused. At that point, it might be a very good and intriguing investment. But right now, with Jack at the head, I don't see how it's investable.
Yeah, I mean, I think the ship turned around pretty much whenever I started seeing that the only new product that they were putting out was a new design of card for people to pick out. Oh, now we have a pink debit card. Now we have a blue debit card. Yeah, cool, man. Their customers are wanting something a little bit more than that. So, yeah, I think they'll survive.
Oh, yeah. Yeah.
Well, I mean, it's pretty hard to talk about survival when they have over $7 billion in cash on the balance sheet.
Yeah.
And they're not in the red. So
I don't even think they have a fleeting brand. I just think that people are not really talking about them too much, and other competitors are much stronger. That's really what I think it is.
Well, you have that. You have a couple of changes in Cash App, but like it's not grown at all. And for them, that's a problem. It's also not been monetized very well, but there's some stuff in there that might be able to be monetized on.
Definitely.
And then on the crypto side of it, they were ahead of things back during COVID because of their integration with Bitcoin. But in Tevis, maybe you can speak to this. I know you're not in Block or anything, but Dorsey is a maximalist when it comes to Bitcoin. And the problem is, like, Bitcoin is great at some things, but being an exchange of value, it's terrible at that. So he's really hindering the company with that approach and with that thought. It's wrong.
Yeah, I mean, look, I think we've talked about this before, and I think you nailed it, Roy, when you said that Jack is a brilliant 0 to 1 CEO, but it takes a different skill set to be someone that, this is why the Mark Zuckerbergs and the Jeff Bezos are so rare, because they can be that 0 to 1 CEO, but they can also be brilliant operators for multi-trillion-dollar businesses. And they're completely different skill sets, right? Like, one is ice hockey, the other is figure skating. Like it's completely different. They're played in the same, field, but they're very, very different sports. So, and you just have to recognize that if you're Jack or if you're, whoever. So,
let's move on to some SoFi, because obviously we have a lot of news. We just came off of earnings. There's been lots of conversation on X about SoFi. Our own great and powerful Stephen Fiorillo has had some colorful thoughts. Why don't you start us off? Mind you, I'd say probably 3 out of the 4 of us were pretty positive on Q1 earnings. But go ahead, Steve, start us off with the negatives.
Well, I got some stuff to go over that I disagree with a lot of people on. And before we get to the conversation that was on X about assets under custody and deposits, which is the most ridiculous argument, I'm going to blow a hole right through that one.
You mean against Amit?
No. All you guys are crazy. He is correct, and I will explain why. But
right, what are we talking about, Steve? I have no context. I haven't been keeping up with the Twitter drama.
I'll go over it in a minute. So the quarter was great. Okay, this was a blowout quarter. I don't know how I came 1 million within adjusted EBITDA. I mean, I think I said 210. They came in 211, or they came in 211. I said 210, whatever it was. This was more EPS and more net income than I thought. They're doing everything they should be doing. So I don't want anybody to take what I'm about to say out of context, okay? This was a pivotal quarter that set the stage for a very strong 2025. We knew going into this that they were sandbagging, they were going to raise guidance. They did. I think they exceeded most of all of our expectations. Maybe not on members, but the rest, revenue and profitability, phenomenal. Problem I have is, once again, there was no talk about the RFP process. It was one sentence that alluded to nothing. And when you come out and you say on Liz's podcast, you want to be a top 15 technology company by market cap, you better give us some stuff to work with. And just because they acquired Technesis, just because they acquired Galileo, just because they're merging those and building their own software instead of going to a third party does not make them a technology company. The bottom line is that on net revenue, the technology segment accounted for 12.63% of their net revenue. On a contribution profit level, technology platform was 7.39% of contribution profit. You're not a tech company when lending accounts for more than 50% of net revenue and more than 57% of contribution profit. You're not a tech company when financial services is making up 37% of net revenue and 35% of contribution profit. Now, I still think the AWS, the fintech story, is still alive. But if they don't do something to seriously show us that that is going to come true and start generating incremental increases of revenue after a big boost on the base on the technology platform, I got to tell you, I don't think that they're going to get a tech multiple or a hybrid multiple. And the reason that this is being valued where it is and why everybody thinks they should have a higher multiple, but it's not, is because they're operating like a bank. They are generating revenue and profit like a bank. So they're going to be viewed as a bank until they give the market a reason to consider giving them a tech multiple or a hybrid multiple. And without them really going in depth on those things, it's not going to happen. I don't know how many times I have to say this.
Okay, so let's go through some things. I feel like I need to slap some sense into you, but I never would. I don't want like some horse head at the foot of my bed.
Well, there's nothing that knocks some sense into me about the numbers I said incorrect. Does technology not make up 12.63% of net revenue?
What? No, it does not. No, it makes up for far more than that.
Technology is 103 million on net revenue.
You can call tech whatever you want to call tech. Okay, you say financial.
I'm not calling tech anything. They're calling tech something. Go to the numbers.
Okay,
tech is 103 million of their net revenue of 818 million. That's 12.63%. That is what they labeled it as.
Listen, yeah, who cares what their label is?
Oh, no. You can't say who cares what they're labeling as when they're labeling it as.
Okay, you said on X that you can compare any two companies because they make revenue and then that flows down to bottom line. So
doesn't matter if you're making widgets or selling freaking AI.
There you go, baby. Now, if you're making acceleratingly fast growth in revenue, and then that is going into better margins or high margins, that's comparable to technology companies, why can that not be a tech company? Or considered the valuation of a tech company? Who cares what they call tech? Their quote unquote tech company part of their business makes a 30% contribution margin. Financial services does 50% and lending does 60%. So what is tech? You know?
Yes, I do know. It's what they consider their technology platform.
No, it doesn't. No.
Do they not report on a technology segment? Do they? Yes or no?
Whatever, dude. They can
not
call
whatever, dude. It's a yes or no question. Do they report a technology segment?
They label technology segment for Galileo and Technesis.
They label a technology segment. And what are the numbers?
I'm talking.
Did I read it wrong? What are the numbers?
This is a bad faith argument.
What are the numbers?
I'll tell you a better number. So
no. I'm asking you a question. What are the numbers?
It was like $103 million this quarter. Okay. And then like 30-something million, 35 million contribution profit.
30.9, but okay.
Are we done?
I'm just saying they're the ones reporting those numbers, not me.
Okay. So the loan platform business potentially made close to
traditional finance, but go on.
Sorry?
Traditional finance, but go on.
Traditional finance. At 50 to 60% contribution margins, completely risk-free. Okay. In 3 quarters, they grew this to $96 million in revenue. That's almost
they're doing a great job, but that's still traditional banking.
I'm not done though. It's almost the size of the tech platform in 3 quarters. It grew 44% this quarter, and their take rate increased by nearly 10%.
Even more reason why they're not a tech company.
I agree, Steve.
My blood's boiling.
Your blood can boil all at once. I'll send you some dry ice or something. Like, it's not a tech company. Sorry.
Yeah, it's not.
Yeah, but it's not a tech. I'm not saying it's a tech company. You can call it whatever you want. It's a high revenue,
is a higher
margin business.
Listen, I'm not disputing that's not a high growth company. It is. It's got great margins. It's got great growth rates, but they're not a tech company. The lion's share of their revenue and profitability comes from traditional finance segments, not technology. That's why SoFi is not getting the multiple. It's very simple. 1 + 1 = 2.
And I agree with that. I would still say SoFi is undervalued, but and we talked about this previously too, I think last week, that I don't think that, the top 15 tech company is realistic or really helpful by Anthony Noto. Top 10 financial institution, yes. And those aren't so different in terms of market cap, at least right now. And it's not that SoFi could never be a tech company. They certainly can. The tech platform there has always had promise. It just has lacked, I don't know if it's execution, macro headwinds, what it is exactly, but it's really underperformed.
Tevis,
anything? These comments are hilarious, by the way.
I mean, like, I agree with Steve. I don't disagree. Like, I don't see it. Like, one thing that I said in my recap of the earnings was that the tech platform stagnation was a surprise, because if you had told us 3 years ago that, when we were saying this is going to be the AWS of fintech, and that was the thesis, that thesis has changed. Now, it doesn't make it any less compelling, because what they replaced that with, in terms of diverting their effort and diverting their growth rate, is something equally, if not even more aggressively scaling. But yeah, I get it doesn't fit in the bucket of a tech company. Like, I understand that. I agree with that. I think both arguments can be true. It's like Steve saying, like, I want a fast car, and he gets a fast car, but then he says, oh, well, this is not a red Ferrari. It's like, well, okay, but it's a yellow Lamborghini. It's still a fast car. It'll still get you there. It'll still meet all your criteria, but it's not what you initially wanted or what you initially thought you would get.
Guys, Jack, I'll throw you a bone, Tanner. It is putting up growth rates on the revenue as if it is a different sector, more like tech than traditional finance.
So that's a fun, I like the way you worded that.
Okay.
Go ahead.
I will absolutely agree with that, because I alluded to that in the beginning.
Yeah.
They are doing things that are creating great growth rates that people that would traditionally, if you did not tell them what they did and you showed them their set of numbers, I think more people would assume it is a technology segment company than a traditional finance segment company.
Right.
Based on, if it was a blind test, you just look at the set of financials. The difference is, there is no difference between SoFi lending versus lending at a money center, lending at a business development corporation. Lending is lending. And if you really look into what BDCs do, I mean, why are you laughing, Thomas?
He's reading comments. Don't worry about him.
Yeah, comments saying it's a Ford Pinto.
Anyway, if you really look into what business development corporations do, it really resembles a loan book to some of them, like an Ares Capital or a FSKKR, et cetera, et cetera. And those are great businesses. I'm invested in a bunch of them. But when I think tech company for them, because this is based on what Noto said specifically in the Bank of America interview, and I can link that later, but he was talking about doing everything. This is right after they acquired Technesis, which was a great acquisition. Right after they did that, he was discussing not just powering their own platform, but cross-selling that to their competitors and powering their platforms. And then that, to me, would make them a SaaS company in addition to a financial institution. And if they got, and I don't want to say any names because we do not know who they're in RFPs with, and if I guess right, I don't want anybody saying anything, because I have no idea. I've never talked to any of them. I've emailed Noto before to congratulate him on shit. That's about it. But if they get a top 4 money center, and if they get one of the larger regional banks, and that gets announced, and they start powering these banks that have 500 billion in assets under management, a trillion in assets under management, and you start seeing revenue generated from their entire platform now being on the Technisys and Galileo platform, and then they start getting incremental increases on CPI year over year from that and drive more revenue. That's the AWS of fintech. That's banking as a service. That is what they outlined. That is not what we're getting by any means right now. And it's been 2.5, 3 years since they acquired Technisys. So how long do we give them until we say this is a high growth financial institution rather than a tech company? Because without that segment, I don't know how they're going to get a hybrid or a tech multiple.
For years, I have not been super excited with Galileo, and everyone, I think even especially you, Stephen, have been super on the train of, if Galileo doesn't work, I don't want to be part of this business.
Pretty much.
And the entire addressable market for their tech platform currently, as it is today, is $20 billion annualized. Okay. They have about 1 to 2% penetration in that market. JP Morgan, across their net interest income, did more of that. Like I think last quarter in Q1, I think they did like something like $24 billion in net interest income. So in my opinion, the total addressable market, how big they can actually get, is way larger on the loan platform side at double the margin. And yet people are not looking at that as if it's, a much better, bigger, larger opportunity for them.
When you talk about Galileo, are you just talking about Galileo, or are you talking about the opportunity of combining both of them and being a platform for not just the financial institutions, but also business development corporations and other types of corporations?
Yeah, definitely areas where they've not been historically. Obviously, that's not in the total addressable market, but whenever it comes to Technisys and Galileo, those combined are about $20 billion a year.
Okay.
For their markets. Obviously not new areas.
Yeah, but does that include, and I'm just asking questions, I don't know the answer, does that take into consideration that most of traditional finance has not moved to cloud banking cores, and they're going to have to move over the next couple of years due to updated regulatory concerns?
No, it does not. It's the current
market. It is when you look at the expenses that all these banks are spending, I would like to think that it is bigger than 20 billion when you combine what is expected to happen in that with the payment rails with Galileo.
Right. Yeah. But I'm just talking about loans is a multi-trillion-dollar industry.
Of course. And they're doing a great job. And I think they're going to do even better when the Fed starts cutting, because you're going to get two big tailwinds. You're going to get the housing market to be unlocked, and you're going to get huge originations on student loans. And both of those are going to do very well for SoFi.
Yeah. I just, I'm surprised with your change of tone, because I find, look at companies objectively without putting them into these buckets of what they're supposed to be looked at like. So, we're looking at a business that is.
Yeah, but you got to remember, I'm looking at this as something that I thought could legitimately 10x because it had all these verticals. And now I think it'll be lucky to get a 1.25x multiple on tangible book value, or 1.5 times.
How does that make sense?
So to go back, Tanner, we don't have to worry about how it makes sense, why it makes sense. Steve's point is, this is the way that the market looks at SoFi, and until something changes with SoFi, it's not going to get be seen as a tech company. It's not going to get the tech multiples. And this goes back to, and probably before your time, you may not be aware of it because you're in Canada. You may have heard of it, that there's a chain down here called A&W, and they wanted to compete with McDonald's. McDonald's has quarter pounders, by the way. A&W is like, hey, we're going to sell 1/3 pounders, which of course is more than a quarter pounder. So they brought in people to taste test it, and it was great. And it didn't sell at all because Americans were like, yeah, I'm not going to pay and get something that's less, because 3 is less. They thought 1/3 was less than 1/4. And A&W ended up losing a lot of money from that. Was A&W absolutely right that they had the better product there? Yes, they were. It weighed more, indisputably. But that didn't matter. What mattered is what their customer base, what the market actually thought of it. And that's really where we're at here. We're not arguing, or at least I'm not arguing against you, that it's kind of silly that they do this with companies like, oh, this gets a tech multiple, this gets this kind of a multiple, when revenue ultimately is revenue, when money is money. Now, there are some nuances, but like the divide is really very vast. But that's just the reality that it is right now. So
okay, so one of the companies that you've stuck to, this whole idea of, okay, well, this is how the market sees things, is like, yeah, that's how you find companies that do outperform, is you find them whenever other people doubt your thesis. PayPal is a name that you've stuck to, and the market is not seeing the multiple that you want on that company. So how's that any different from SoFi?
Well, it depends on what your argument is, Tanner. If your argument is, loan platform business and they're not giving the value of that, great. That's a great argument, and I agree with you. If your argument is SoFi is a tech company, it should get a tech multiple. That's I know, but that was part of the discussion earlier. And if that was somebody's argument, it's just not going to work, because you're trying to convince Americans that a third of the pound is more than a fourth, and it just, for whatever reason, it didn't compute, it didn't click. So, but no, like I think that if that's alpha, is when you see with a company that you're like, okay, the market is perceiving it as trash, I see that it's treasure, and your whole thesis doesn't rest on the market changing, like as far as the way it sees the company, other than with actual results, you're fine.
Yeah, I'm not calling it a tech company or really any sort of company other than a fast growing. I think it matched, or if not beat, the revenue growth of Palantir year over year last quarter. It came in with extremely high margins. It's going more fee based, so less potential risk. They want to get that over 50%. I don't see where and then the area for where it's underperforming is the least exciting area in the entire company. Like the lowest margins in the entire company come from the tech platform. There's no growth there. And then people go, oh, well, this is why we should sell off the stocks. Like, no one gives a shit about this part of the business anyway. That's all been theoretically amazing, the tech platform. The actual amazing part, the lending and the loan platform business, has way outperformed, and everyone has given it this much multiple.
Yeah, I disagree with you on that too. Like, the issue is, yes, the tech platform is the least exciting. It should not be. And if you go back 3 years, that was a segment that pretty much everybody was the most excited about, including the company themselves, the way that they talked about it. So if somebody entered SoFi and they said, okay, great, AWS of Fintech, emphasis tech, amazing tech platform, this is my thesis, let's go. And they get to the point today where they're like, okay, my thesis is busted. It makes complete sense for them to sell. Now, for myself, I've mentioned this before. If they did not have the loan platform business, I would have been reducing my position. That's an incredibly bullish thing. But if somebody's thesis changes and it's broken, it usually makes sense to get out of the stock. And I'm speaking directly to Steve with Block.
Yeah, no, look, I get that. And when it comes to traditional finance companies, they're really looked at on the book of assets and book value. And most finance companies, I've looked at a lot of them. I don't want to say all because I don't 100% remember, but out of the 30 that I follow, excluding SoFi and Hood, none of them, to my knowledge, traded 2x book value. Now,
banks?
Correct.
American Express, 6x?
They're a credit card company. They're not a bank.
I mean, they are a bank, but
Not a bank.
New bank.
Yeah, Nubank.
Okay, so the ones that I follow, and you guys have seen the chart because I put it in SoFi articles before, it's the regionals and the big money centers, all the big US banks. I don't think any of them trade at more than 2x book value. I think one of the largest multiples is JP Morgan, and not many of them trade at a big discount either. Citigroup's normally the biggest discount at like 20 to 30%. Now, if they cannot convince the market, and this becomes perception, and I'll correlate this back to Palantir at some point, but it goes to the perception of the market. And right now, the perception of the market is SoFi is doing everything a traditional finance company does, regardless of the growth rates, and that's why they're not giving it such a huge multiple.
Right now.
right now.
Palantir at one point was a single-digit stock and was also viewed as a consulting business.
But they were wrong, and I can go down the whole rabbit hole on that, and now it's so overvalued.
But I'm telling you that based on the growth rates of SoFi, it's incomparable to a JP Morgan or any other bank that you could name. It's got faster growth rates and higher margins.
6th or 7th year, or whatever, as a public company, and it's still in its infancy. You're talking about legacy banks that are over a century old. When you're a smaller company, you can grow at a quicker rate, and their growth rates are probably going to
but that doesn't matter at all.
Of course it does.
No, it doesn't.
You grow quicker when you're a smaller company. The bottom line is, for SoFi to get these big multiples that we all feel it should deserve, it has to produce on the tech side. Otherwise, at a $6.05 book value, it's going to be very hard to get to a 3 or 4x book value valuation. I just don't see how they get there, even if they grow that to $8 this year. And if you look at the growth of it over 2024, it went from 529 to 596. There wasn't even $1 of book value growth. So let's just say that they go from 596 to close of 2024 to $8 without the tech component and without convincing the market it's a tech company, or it generates a significant amount of revenue from tech and has the ability to expand that. It's going to be very hard for them to get to 25, because that would be more than 3x their book value at an $8 book value, which they may not even hit this year based on their previous history.
But that's just assuming, like, the underlying assumption there is that the tech multiple is a higher multiple just because it has, a tech component. You have traditional financial institutions like Nubank, for example, right? Like, I don't think anybody is calling Nubank a tech company. They're calling it a bank, but it has a higher growth rate, and so it has a better multiple. Or even like, the growth rate should determine the multiple, not necessarily how you get that growth rate. I know the market operates differently. I understand that in reality. But what I'm saying is, if they can get the growth from the loan platform business, right? The loan platform business, 300%, for non-interest income for the financial services segment. Like, I don't care if it has a tech multiple or if it has whatever other multiple. If they can keep putting up those types of growth rates, sooner or later, the market will pay attention.
No, they haven't so far, and they haven't
so far. But at the same time, Steve, they haven't put up growth rates like right now up until this point, right? The loan
they're re-accelerating.
Exactly.
I mean, they grew at 37% last year over year.
Yeah, but here's the thing. It's not at the same margin. So whenever you're comparing years that they've been potentially unprofitable or just breaking profitability to now them throwing a way higher percent to the bottom line, if you're talking about growth rates
I'm just talking about revenue. I'm talking about top line revenue growth grew at 37% last year. That's pretty phenomenal.
It is. But now we're going to see more growth on their bottom line as well, which is going to allow them to, potentially catch more investor eyes.
Maybe.
Dude, the way I see it, if people say, oh, it's a student loan company, it's a personal loan company, it's a tech platform, it's all this stuff, until the day that SoFi misses on guidance, their path to that, to hitting their guidance doesn't matter. As long as it's high margin, fast growth, and a good outlook going forward, I don't know how people can get worried about SoFi, especially whenever the markets that they're tapping are larger and larger. So, like, I don't know. Every quarter, this company continues to beat our own expectations and then raise.
And every quarter, the market says, I don't care.
The company has doubled since the last couple quarters that we were talking. Like, we used to cover this company at 6 and 7, and now it's 12 and 13. And people are saying that the market's not reacting. It's beating the S&P.
Yeah, but remember where it came from.
Yeah, I was. So this is another thing that people bring up all the time. They go, oh, look at the company from IPO. I didn't like this company at IPO. I didn't like it at 20. I didn't like it at 25. We weren't covering it back then. We started covering it in like the low teens.
So, and don't forget, Noto was buying shares at 14 before it fell.
Yeah. But that's a lot different story than 20.
It's a lot different story. And this company has completely transformed, and it's a great company. All I'm saying is that the prospects for these big multiples are slowly leaving.
Someone says it's sad that the stock can't get past $13. It was 18 like what, 2 months, 3 months ago? Like this was like recent history, and people are making it out like this company can't see a higher multiple. It did this like in super recent history, that this company got boosted up on people thinking that rate hikes were going to continue to come and that they would benefit. Like we've seen this company just get massively rewritten from 7 to 18. And then now that it's seeing a drawback, I'm seeing comments again saying back to zero. It's like, do I need to go back in history and show you guys what has happened? The company's stronger today than whenever that happened. You know, more book value, more fee-based revenue, less reliance on their own balance sheet, even though they have a larger balance sheet.
So let me ask you something. What multiple on earnings would you say is appropriate for them, given, let's just say, another 2 years of growth? Let's give them 2 years to grow into it. What would you say is a fair multiple on earnings to be paying for SoFi at that point?
You're asking for a 2-year forward PE?
No, I'm just saying in general, because we all, I would say, believe SoFi is going to continue to grow and continue to do well. Okay.
Sure.
What do you think in 2 years from now, when they've acquired all this new growth? Do you think a 30 multiple on earnings, a 20 multiple, a 40 multiple? What do you think would be appropriate?
Yeah, I mean, I could definitely seeing it hold a 30 plus multiple on earnings there. Like,
Okay.
It depends what percentage of it is fee based. If they're fast growing, high margin, all fee based, we're looking at like like an Amex or something. Like most of it is fee generated. People can call it credit cards, or SoFi can call it personal loans. It's all the same. It's all about what you bring to the bottom line. Like, I don't know. Roy, you want to pitch us in your thoughts?
Yeah, no, I just it was a segue. I just wanted to talk a little bit more about the tech platform in the comments that were there.
Sure.
And also touch some other things from the earnings that I thought were really interesting. But on the tech platform, so there were a couple of comments. One is actually even they mentioned the tech platform so few times, and usually they update as far as the pipeline. Noto didn't until he was actually asked by an analyst, and he basically reiterated everything that they said in previous quarters. And that may be why they didn't share anything, but I thought this was interesting. The actual number of accounts, that's a pretty interesting dip there. And I know he said that they signed a number of new people that will onboard, I think, later this year. Revenue will come in 2026 for the tech platform. But is this concerning?
So did you hear about when they lost this client?
No.
They lost this client in 2022. And then they fully got it off the books today.
That's current?
No. Sorry.
Not current.
No, this is a new undisclosed client.
Okay.
I haven't done any deep dives into finding out who it is.
Right. Well,
it's clearly a large customer.
Yeah, that's actually pretty massive. So yeah. And then of course, like the revenue just it's flatlined. Like this reminds me of Cash App.
Well, Cash App looks better than this.
Well, as far as like revenue though, like it's not revenue as far as clients. So yeah, you're right. Actually, it is
right. In terms of Cash App, the monthly actives look like that. Yeah.
yeah. It's I don't know. Like I'm always bearish on the tech platform, and then they somehow underperform what I expect, and it's like, man.
Yeah. See, the problem is that I think that they should disclose. They said, "Oh, we lost this customer back in 2022. They're only now getting off the books today."
Yeah.
What I would ask management is, how many customers have dropped off the platform since 2022 that are not showing up on earnings today? Does that make sense? Like, are we going to lose some customer in 2026 and they say, "Oh, we actually lost that back in May of 2025, but we're just not hearing about it." Like, so at the time that they're lost, they should tell us that they're going to be dropping off the platform, not that we get smacked with it later on. Because this is some of the reason why I think the earnings expectations are so weird about SoFi is like, we can have massive customer growth or customer gains or massive customer drop-offs, and yet, revenue continues to climb. So it is weird there, but they are still expecting large growth. I should not say large, but more than I would expect from the tech platform given the last 3 quarters for the rest of the year. I think it's teens right now of year-over-year growth for the tech platform. What are your guys' thoughts there? Like, do you think we're going to even hit it, or do you think it's going to be continuously revised down?
I think that it's going to get revised down.
Tevis?
Sorry, what was the question?
Do you think that the tech platform revenue is going to continuously get revised down, or that we're actually going to hit that teen rates of year-over-year growth this year?
Well, they did mention, so the deals that they announced in the Q4 earnings, they did mention that the revenue was going to be staggered and was going to show up in 2026. It's kind of a rock and a hard place for them because they know already what the next quarter is going to be in tech platform deals because of the lag time. And right now they're working on deals that we won't see manifest on the actual financials until 2026, probably 2027. And so they're getting all of this hate from the rest of the community around how the tech platform isn't performing. And they could very well have a understanding of what that growth curve looks like, whether it's going to reaccelerate or whether it's going to stagnate even further. I do believe management, when they said in the Q4 earnings call that, hey, towards the back half of 25 and towards 26, you're going to see more revenue in the tech platform, because it's not just like, wishy-washy promises. It's them actually knowing what revenue is going to be from the deals that they've already closed like 6 months prior.
So I agree with that thought process. I've got 2 points that I want to make. One, I don't think we're just going to see growth from the deals today that are going forward. We're going to have seen deals that were signed 2 years ago that are showing up today, if that makes sense. However, last year they said 20+% growths, knowing full well what their pipeline and revenue expectations were going to be, and then they continuously revise them down. So those were on deals that they had already known. So what's going on there?
Yeah, that's everything else in their guidance is impeccable. They're going to meet or beat. If they need to shift something in a quarter, that's fine. This is the one that should be the most predictable, and it's not. And I think it's just a weak segment. And at least the way that I'm approaching SoFi right now is I'm not counting on tech platform to do anything at all, like period, other than what it's doing right now. It's like, if there's any upside on it, that's awesome. It's sunk cost. They overpaid. It happens. It's kind of like honey with PayPal. It's like, it exists. I'm not putting any thesis on it at all. And actually, it provided some downside. So,
Roy, what did they overpay for?
PayPal, honey.
Almost every single acquisition that they've gotten themselves into.
Venmo and Braintree were good. Happy returns.
Yeah.
You could say Zoom maybe, but yeah.
Yeah, you're right. Definitely the best example is Braintree and Venmo. Any company would have wanted to acquire those businesses.
Yes.
So Tanner, what was the Twitter beef? So you can let Tevis know, and then I'll give you my opinion on it.
Well, even calling it Twitter beef, like,
all right, maybe that's not the right word. The Twitter discussion.
Yeah. Because I think whenever people see, DDI and Amit or any of these guys going back and forth, they think there's some sort of animosity or anything. I just think it's a bunch of online personalities that obviously like to argue for a living. Now, Amit put out a post saying that, he's feeling a little spicy today. He wants to go to war. He thinks that SoFi is a crap company and Robinhood's a great company. And the way that you can determine that one is crap and one is good is that the net deposits for SoFi was 1.9 billion and Hood's was 18 billion. And yet the member difference was 11 million to 25, some odd million for Robinhood. So the deposits per user is way off, and that means that more people are choosing to put more of their money with Hood than SoFi. And also the fact that SoFi does not disclose monthly active users. So obviously they're trying to hide something, meaning it's a shitco. Steve, or actually, let me ask Tevis first, because this is the first time he's hearing this.
Mhm.
Tevis, what is your original thoughts on, or your first thoughts around some of those points?
Sorry, I didn't even get what he was arguing. That Hood has higher deposits per member.
Correct. And that means that people are liking their ecosystem more, putting more with them.
But like, how much money are they making off of those deposits per member?
Less.
So isn't that like, if I can have, I don't know, then this is just me thinking out loud because this is the first time I'm literally hearing this argument, or this post. I haven't been up to date on the Twitter verse, but like, I've brought up the same objection whenever you talk about Nubank, right? Like, oh my gosh, New has all of these, customers and this and that, and meanwhile you find out that they're, monetizing like single digit dollars from those customers. And so, like, okay, great, if the numbers are there and they're true, then the first thing I have to ask is like, okay, well, how much money are they making off of those deposits per member? And if it's like drastically different, then that's the thing that we should be paying attention to, not necessarily the deposits per member in isolation, right? Like, the deposits per member is an input to another number. Am I thinking this wrong?
That was kind of the argument from SoFi.
Let me ask you a question. Would you classify how you quantify that in total operating income?
I'm not sure.
Only because it's drastically different. Robinhood's TTM operating income is 1.26 billion, and SoFi's is 219 million. So effectively, whatever money is going into the actual ecosystem, there are services being used to generate revenue and profitability, and there is a large disconnect between both companies' profitabilities.
But so how do you, like, how do you get to the operating income point? I'm saying, like, how much money are they making from the deposits being in that ecosystem?
The reason I go there is because I don't know that we can drill down on the very specifics.
So what I'm saying, Steve, is like, okay, if SoFi has my money in the system, they can use my money to lend it out to people.
You want to know what the rate of return is on your money in SoFi's ecosystem versus Hood's. And what I'm saying is, I don't know that we can actually quantify that. So that's why I asked if it ultimately drives down to an overall profitability metric, whether it's EBITDA or operating income or net income, because I don't know how we can quantify it without having the inner workings of those companies.
Well, when you think about, and again, this might sound stupid because I'm just thinking out loud here, but when you think about the net deposits, is that only from the gold cohort, like the banking side of Robinhood / credit card side of Robinhood, or is that just in general, like the brokerage side as well? Because if it's just the credit card and the banking stuff, then you could just look at the earnings report for the sponsor bank and you can have a better idea there, no?
Tanner should be able to answer that.
I'm not even really sure what you're asking.
Is the 18 billion brokerage?
Yeah.
Or is it just credit card and whatever?
No, it's their entire business. So brokerage obviously brings in more assets as people get wealthier. They transition more from checking accounts into longer term savings. That's why more people, like, I think data-driven investing had the greatest sort of checkmate answer. I don't know if I'll be able to find it. But he brought up talking about assets under custody. Let me see if I can find it.
I have it up.
Do you have the Schwab versus JP Morgan one?
I have the one where he said bringing in brokerage assets under custody is very different from bringing in savings deposits. No, it's not. It doesn't have anything to do with Schwab. It goes into the MAU discussion.
Yeah, so I think he brought up like Schwab's assets under custody was something like 10 trillion, where JP Morgan's was 4 trillion. So much, much higher than JP Morgan's. But JP Morgan's market cap was something like 5x higher. You know,
The other thing too, beyond just how important direct deposits are compared to just assets under management or under custody, is what the bank can actually do with the assets there. When you have a banking license, there's so many things like right now, and this is changing, and it'll take time, but that hinders you, and it's a liability as a bank. You have a lot of extra regulatory scrutiny. You have products that you can't even touch or anything that you do, but this is the advantage that you can get that direct deposit stuff, and you can leverage that to actually lend against it, not just on a one-for-one basis. And that's very important for SoFi.
So this is what I pretty much said to Amit on the phone when he called me to ask me my opinion. I don't agree with everything that he put in here, but I think it's a big problem for SoFi that Hood got 18 billion in net deposits in Q1, even if it is assets under custody. And here's why. To me, it doesn't matter if it's a deposit into a savings account, checking account, or a brokerage account. Into a brokerage account, I would think is much stickier than a checking or savings, because I'm not pulling money out of a brokerage account, but I'm moving money around for whatever reason between savings and checkings and outflows to certain things, whether it is to a brokerage, to pay bills, et cetera, et cetera. When you put money into a brokerage account, especially Hood with their enticing 2 to 3%, depending on how much money you move, now it's locked up for 5 years. That's 18 billion SoFi's never getting. And the fact that SoFi has an investing core and that money flowed into Hood instead of SoFi is a huge problem. And it shows you that more people are throwing their money into Hood's ecosystem, regardless of where it's sitting, than in SoFi's ecosystem. And to me, that is a very big problem. It's a brand image. It's many things.
Yeah, I don't think it works like that. This is like
Absolutely
saying
does. Tanner, if I take 100 grand and I throw it into a savings account, or I take 100 grand and throw it into a brokerage account, I'm putting that 100 grand somewhere.
There's 600 million monthly actives on ChatGPT, and yet you're still a shareholder of Google. Like, I don't know. There's multiple players.
Are you not a shareholder of Google?
I know. I didn't say your ridiculous argument.
Google is undervalued here based on their profitability. All I'm saying is you have two options. You have Hood and you have SoFi. You had 18 billion go into one and 1.9 go into another. That 18 billion that went into Hood, those people had the ability to put that into SoFi, but they chose not to. Now, regardless,
not even really. Like,
well, does SoFi not have an investing platform?
Yeah, but not the same level of products or different account types.
Do they have brokerage accounts?
Yeah, but what if you have a certain account type that you don't have at SoFi that you do at Robinhood?
Does SoFi have brokerage accounts? Yes or no?
I mean, you can pass that question.
It's a yes or no question. Do they have brokerage accounts?
Yeah, but it's not a yes or no answer.
It is a yes or no question. Do they have brokerage accounts? The answer is yes. Does Robinhood have brokerage accounts? The answer is yes. 18 billion went to Hood instead of SoFi. The real question is why? That's the real question. Why did so many people decide to put their money with Hood than SoFi?
They are the better brokerage.
There you go.
Okay. Yet one company is still growing gangbusters and doing fine on their own and surpassing guidance.
They're both doing fine.
Okay, so this is like we're talking about this like, oh, you know, this person bought an iPhone, so they're never going to use Android. Like I don't know. There's thousands and thousands of options in the finance space, even just for brokerage. That's a $30 trillion industry.
That putting the money in Hood when you're getting that level of a match with a 5-year kicker, that's money that's never coming out. Somebody who just moved 250 grand or 500 grand into Hood to get that 2% match, they're not moving it for 5 years.
No? What if SoFi
offers that's not flowing back into SoFi or somewhere else? Hood's got them. It's very sticky.
SoFi offers 2.5% or 3%. I bet some of those people break their contracts with Hood to get a little bit more over on the other side.
I don't understand what the argument is. Like,
yeah.
Okay, sure, Steve. Hood has the better brokerage. Hood has the better product offerings from a B2C side. Hood offering is better than SoFi Invest from a product perspective. Okay, what are you trying to prove? Hood got more in deposit.
Keep in mind, I don't own a single share of Hood. I own a
Sure,
lot.
I don't understand what
I own a lot of SoFi. What I'm saying, and Roy's laughing because I sold this Christmas present. But the problem,
it was a good one. It was a good one.
It was a great one. I'm just not a good gift giver. But the problem that I am trying to get to, that I have a problem with, is that people are obviously equating Robinhood with a better platform than SoFi, and that is making them put money with a competitor. I want that money coming into SoFi, and SoFi needs to do a better job at one, showcasing what they can do and get people excited about using their platform. Does anybody hear anybody talking about SoFi Invest? I don't.
I hear a lot of people talking about SoFi's loans.
Okay, but I'm talking about the invest, the whole brokerage side. I don't hear anybody talking about it.
But on a one-to-one,
Steve, but like-
Robinhood versus SoFi, obviously Robinhood beats the brokerage side. But thank God you're not investing in SoFi Invest and you're buying the whole ecosystem.
But
I
Steve,
get that.
like the Invest platform, throw this up real quick, Tanner. This is pretty incredible. Did you see this? We continue to add more selection. By the end of the year, if all goes as planned, we will add, there it is, level 1 options. We got it.
Finally coming.
Yeah,
the
after
crypto
3
stuff I do
years.
want to talk about. That's actually really cool. But the other I just thought was kind of funny.
Yeah, but like, okay, so Steve, and I hope you know, like, I agree with everything you're saying. I just disagree with the premise that they have to dominate every single field that they play in. They can pick and choose where they allocate their resources strategically to carve out their niche. Like, and he literally said it in this interview. He said, the winner in brokerage is going to be Robinhood. The winner in buy now, pay later is going to be a firm. We're trying to carve out our competitive advantage. And it was like the clearest it could possibly be that they're going to allocate resources to the loan platform business because that's where they feel their best competitive advantages. And so, like, even if they, like, I think a lot of the stuff that they roll out, they don't roll out to be the number one in the space. They just roll it out so that they have an ecosystem where whoever else is in that ecosystem has the full end-to-end, suite of products. And then they can focus elsewhere. So, like, I don't understand. Like, it's like you saying, technology platform is not growing, therefore I'm going to sell SoFi. Well, technology platform is not growing, and yet you still said I'm still very bullish on SoFi. Like, you can have both, right? Like, Robinhood is going to be a winner in brokerage, and yet I can still invest in SoFi because they're still also going to be a winner, just not in brokerage and something else. I think the biggest loser from this entire space is the legacy financial institutions, and everything else is just semantics on top of that.
If I could also add, if your argument would be the exact same if you were talking about cloud providers or ServiceNow and Salesforce very well. Mm-hmm. If one company signs with Salesforce, you could go, every single client that's ever gone to Salesforce is not going to ServiceNow. Or, these companies are going to Google Cloud Platform. AWS doesn't have a chance. Like, there is enough room for all three to win here. There's definitely enough for Robinhood and SoFi to win.
There is enough room for all of them to win. And you're right. There are many different platforms out there for brokerage. All I'm saying is that when I see a number that big versus what SoFi is bringing in, okay, I would like to see some of that money going into the SoFi ecosystem. That's all I'm saying, because when the SoFi eventually rolls out level 1, and they can start monetizing it, they already have their proprietary ETFs and mutual funds, it's more fee-based revenue for SoFi. All I'm saying is that they need to figure out a way to chip away at Robinhood's lead. And when you see numbers like this coming in from Robinhood, it makes me think that people are not going to move their brokerage money over, and we are not going to get that incremental revenue from fee-based services on the investing side. That's a little scary.
I mean, look, man, if you had asked me 6 months ago, I would have absolutely agreed with you. And I would have been like beating the same drum to say they need to chip away at Robinhood's lead. But if you ask me today, after the earnings that I saw on Tuesday, I'm okay to say, well, you guys should allocate the majority of your resources to give me the 321% growth rates on the loan platform business and to generate, millions upon millions on the loan platform business deals, because I can arbitrage that difference. I can get way more money as an investor from the loan platform business than I could have ever gotten from SoFi trying to optimize the invest platform, because we've seen them do it in the past and the caliber just isn't there. And I don't want them to basically, work on something where the ROI is not there. Like, I'm okay for them to even lose more market share to Robinhood to focus on the loan platform business, because that's where they're going to make more money.
Legitimately, the loan platform business, as much as we talk about it so much, is not being talked enough about for SoFi. Like, it's already more than 10% of their revenue. Like, it's been 3 quarters. It's going to make up for such a large bulk of their earnings. And I don't know. It should actually be separated from financial services. It should just be its own revenue source, because it's so freaking big. And I also, by the way, Anthony, note of talking directly to you, that might actually help people visualize some of the segments of your business, is if you separate them a little bit, because just financial services and lending is not the real segments of the business. And this is what I like about Hood too. They break it down into the 10 different earnings results, so you can actually track what's doing well. Similarly with Amazon. Imagine if Amazon was still tracking advertisements, 56 billion annualized under other revenue. It actually does make a difference to bring it out.
1,000%. Like, financial services reported 101% growth rate, right? Like, and I look at, and I saw Robinhood's report, and I was very pleased to see it, right? As a recent shareholder, it was up 50%, and then net income was up over 100%. Like, great numbers. But at the same time, like, you also have SoFi that's growing over 100% in financial services. By the end of the year, financial services will be their biggest revenue driver, and it will accelerate in growth. That's what they said literally on the call on Tuesday. They said Q2, we're going to have more loan platform business deals because of the ones that they just signed with Fortress and others. And you're looking at this growth rate there, you're like 101%. And a couple of quarters ago, it was 85%. And now they're going to accelerate that even further for financial services. Like, that is something to be
the
very
contribution
excited.
margin that doubled year over year.
Exactly. Yeah.
The margin doubled.
25% to 49% in contribution margin.
Name another business that's happened in, where the business doubles and the margin doubles. That doesn't happen. Steven.
Listen, I'm still angry at SoFi. I don't know what you want me to tell you.
So can we real quick? Can I just share the crypto thing and as a topic for SoFi, and then maybe we can quickly talk Robinhood and PayPal earnings too.
We need to talk Palantir also.
We're already at an hour, by the way.
Palantir maybe in the after hours.
I think the after hours. Ladies and gentlemen, we would love your support in the chat. We're going to bring the after hours into public viewing. These conversations where we go a little off topic from SoFi is usually held behind a paywall to the most supportive viewers on the channel. Thank you all so much for that. But if people subscribe, we're gonna make it go public. But continue, Roy. Now that everyone has subscribed, thank you all so much.
So I thought the most interesting part of it, and I kind of alluded to it already, was crypto. I've got the transcript up here, but I can just read it. It's fine. Beyond the level 1 options, they said, in certain crypto or blockchain offerings, given the evolving regulatory landscape, we see an opportunity to re-enter the crypto and blockchain business more comprehensively, in addition to enabling its members to invest in crypto coins, which is the invest platform that they had before with crypto. We will enter other areas over the next 6 to 24 months, but potentially much sooner via acquisition, or if the changing regulatory landscape allows. And this I thought was really interesting for a couple of things. So we all knew about the crypto invest platform. Last week, I forgot who captured it, but it might have been Vadim, it might have been somebody else, had the listings of all those new people that they were hiring on the crypto platform. And that was a lot more than they needed just for the invest side. So I was like, okay, they must be looking to build something else. Here we have an idea of some of those things, and that with some, we'll see how they do. But integrating stablecoin and integrating, and then he actually talked about stablecoin elsewhere, but integrating crypto as well into payments is significant. Lending as well. And then I thought that the word acquisition was very interesting because we hadn't seen one of those in a little while too. So what do you guys think about that?
if I could start, this is one of those things, maybe like the tech platform. I think everyone's getting excited about it. Mark my words, it's not going to be anything. If crypto-backed lending has been anything back in the day, I'd be okay with that. But legitimately, no company has pulled it off. Maybe BlockFi or something like this. You could pull up all crap businesses. Maybe it comes, popular in the future. But right now, I think it's a little bit fugazi. Any other comments? Steve, Tevis, are you guys getting excited about crypto?
No, not in the slightest. No, I don't think many people are going to use SoFi for crypto.
Okay, so hold on. I think transactions on crypto will be big. I think people will buy crypto. I don't think any of the additional services are going to make any difference. Sorry.
Look, I found, like Roy, the word acquisition to be interesting in there. Why? Because they already had a brokerage back in whenever it was before what was it, 2023 or 2020? Yeah, 2023. I think that they were forced to close it down. And so in my mind, logically speaking, they wouldn't go through an acquisition path to just have the brokerage again. They would only look to an acquisition if the acquired party had something that they didn't have and that it would take them way too long to build in-house. And so this is why I think that they're actually going for something much larger in the crypto space, just to present another, counter argument. Because if it was just for brokerage, they can flip that live tomorrow because they already have all the code. They already have all the infrastructure. Galileo already supports all of that. So it's just one thought, right?
I don't think it's that easy. I think on the back end, it's going to be a lot of things like routing the orders and stuff like this that maybe aren't.
They don't need to buy a company for that, is what I'm saying.
Well, look at Wyndham Capital Mortgage. They could offer mortgages before Wyndham Capital Mortgage, yet they acquired a company just to, sort of hammer out the dents.
I hope they don't buy a crypto company just for the brokerage. Let me put it that way.
Right.
Yeah. No. I don't know. We'll have to see too. Like he mentioned stable coins as well. So it's something that he mentioned, in that interview with Liz Young, and that's a huge opportunity.
He brought that up back whenever talking about Doge. Do you remember that? I think it was Lutnick that was looking for some technology provider or whatever. And Anthony Noto said, hey, Galileo can do this. We can offer a stable coin backed 1-to-1 with US dollars.
Yeah. Yeah. No, I do recall that. And like, if you look at like Quarter or something, you search for stable coin, one word and also two words, because, it captures it differently at times. It's a big deal. Like you can see the companies that are talking about it, that are looking to ramp it, like pretty much every single bank that's out there too. So it's not just the first thing that he said, it's also stable coins and integrating those in the payment. SoFi, we'll see how they do. I don't know, but I wouldn't count them out just yet. They are held back for the time being by regulation. And of course they're hiring people. So obviously they don't really know, or at least it seems like that they don't have who they need to be able to build out these products yet. So we'll just have to see how it plays out, but it's not a small thing at all. I would put more hope and trust in this than the tech platform.
Can we transition to a different topic really quick, or do you have other thoughts to say on this?
No, that's fine.
So let's transition a little bit more after dark. Palantir, Stephen.
Yep.
What are your thoughts? I saw a pretty interesting tweet. We have somebody that disagrees with you, somebody that agrees with you on the chat. Oh, never mind. We don't have someone that disagrees with you. Roy just left.
Yeah, so I want to share my screen and show some numbers, but I normally don't really tweet much. I'm actually shocked that this has gotten 147,000 views in 24 hours. But Palantir, I saw a chart the other day of Nvidia versus Cisco, and people are trying to say that Nvidia looks like Cisco of 2000. That could be the furthest thing from the case. Palantir looks like Cisco in 2000. And let me share this because these numbers are eye-opening. I'm sorry, when you get numbers like this, can you guys see this?
Also, I thought about this whenever looking at your numbers. You should really consider potentially looking at them in the millions of dollars rather than like you're going all the way down to 2 decimal places. You're showing me here. There's not a single penny on this whole chart yet. I just look at a million zeros.
Yeah, I want to be accurate.
Clean it up.
No, it's for scale. So
you get rid of this. You get rid of the decimals.
These numbers got even more inflated. I mean, I could bring it up in Google Sheets and show you the new numbers because they're even crazier right now. This is from yesterday. But
what are these other companies that you've cherry picked here, Steve? Like how do they relate to Palantir at all?
So Palantir is a SaaS company, correct?
You could legitimately, Tevis, you could look at this from any other company on the market. You can compare this to CrowdStrike. It looks expensive, like any company.
Look at the bottom. This is Adobe versus Palantir, both SaaS companies. Okay.
Sure.
Palantir had yesterday was $115 billion bigger market cap, yet Adobe does $19 billion more in revenue, $17 billion more in gross profit, $8 billion more EBITDA. Talk about free cash flow, more than $8 billion, more than $6 billion in net income. Margins, everybody likes to talk about Palantir's 80% gross margin. Cool story. Adobe's got an 89% gross margin. Better margin on every line. They do 2,433% more EBITDA than Palantir, yet Palantir is a bigger company. Palantir could grow at 100% rate on every profitability metric for the next 3 years, and it would not generate more gross profit, free cash flow, or net income or EBITDA than Adobe. And when you look at
that total revenue, is that yearly?
At trailing 12.
It almost is at 100x price to sales.
Yeah, it's trading at 593 times net income and 240 times free cash flow. So look at the top bar. Cisco, and I get it, it's a boring company, but the bottom line is they do $54 billion in revenue. Talk about profitability, $14.5 billion in EBITDA compared to $342 million for Palantir. Free cash flow, which is Palantir's second largest, or it's its largest profitability metric. Palantir does $1.14 billion. Cisco does $12.8 billion.
So, Steve, I think the thing that you need here is growth rates for all 4 of these. Like, I think we can't have a real discussion unless you have some type of.
But Tevis, think about this. I'm saying if Palantir was to grow every line at 100%, okay, which they're not going to do, they're going for like 35% or so. If they were to grow at 100% this year, next year, and the year after that, they would still not generate more profitability than Adobe or Cisco.
This is the problem with the market.
Both of those are smaller companies than Palantir. It's crazy.
I have them, by the way, at 44% year-over-year growth for this quarter coming in. We'll see on Monday, but I think that they do get above 40. It's still expensive. I'm not saying it's not, but they're growing like gangbusters right now.
I mean, yeah, even
100 times sales. Like, come on, this is ridiculous.
I'm not arguing the valuation, Steve. I'm just saying they're growing a lot faster than Adobe. So they shouldn't.
But once again,
this big. But
this goes back to business 101. Okay, and I get it. Palantir is growing at a quicker rate, but that does not mean it should be a more valuable company today. Can it get to become a more valuable company? Absolutely. And I think it will, but it should not be valued today for what it may do in 7 years from now. And there is no way that a company that is generating 1/10 of the profitability should be bigger than a company that is generating more than 10x the profits. Because
what do you think the fair value is, Steve?
$45.
Like 34.
34.
I mean, I'd have to bring up the spreadsheet and actually plug in some market caps, but yeah, I mean,
Can we talk in market caps instead of just stock prices?
Okay, let's
Yeah,
talk in
it
market
is,
caps.
Yeah, that's
Right,
Let's talk
68.
in market caps. Palantir is the next Salesforce. Very common saying. I hope that it is in the future. Today, Salesforce is 263 billion. Palantir, 293 billion.
It's even
It's
bigger.
more expensive than the company that it's been compared to its whole career. This is literally the definition of a bubble.
it is absolutely a bubble.
It is the definition.
So okay, like,
And
okay,
then people point to a NATO contract like that means anything at all. Like NATO
It
will
depends
pay.
what they were trying to say, but it wasn't an effective argument. I think that they might have been trying to say that it's more than just a SaaS company. It's half defense, half SaaS.
Yeah, but
That's
that doesn't
fine.
matter.
That's
There's
actually
No. They're not
margin.
making missiles. They're making software for defense. It's a SaaS company.
so
Yeah, I agree.
They make revenue that goes down to bottom line, and that's their earnings. Okay, it's at a certain growth rate. Honestly, the company you should have compared it to, Steve, was Nvidia.
Yeah.
hold
I
on.
mean, would you like me to? I
Can
could do it right now live.
I throw some numbers out there? And I want to see if the gang disagrees or agrees with them. All right. 2.8, Roy, keep me honest on the numbers. 2.8 billion roughly in revenue. Yeah.
Trillion.
Yeah, share my screen again. I have it up.
Yeah. So okay. What are we looking at here? Palantir is, so 2.8 billion in revenue. Growing, let's say mid 40% range. Let's say 50%.
I wouldn't even say that. It's mid 30s.
Hold on. Well, okay, whatever. Let's say 40%. Would 50 billion be something? And like that 50 billion is like what, almost 25 price to sales, right? In terms of market cap, would that be over or undervalued?
I don't look at price.
50 billion puts them still at 44 times free cash flow.
I'm being generous. I'm just trying to prove a point, right?
I would
I
say
get it.
undervalued.
I get it.
You would say over or under, Roy?
Under.
Under.
Mhm.
Okay.
Yeah, I just don't get the reason why.
So
Why I see them as undervalued there at like 50 billion market cap?
Yeah, it's just like I just feel like people are just watching this company's valuation change, and then they change the story to match the verdict.
I'm not doing that. So don't lump me into that. You're a TAM investor, and you should see the TAM of Palantir. It's massive. We've talked about this before. I don't think you're really disputing you. I think you do see it smaller than I do, but it's immense. Their moat is immense, and their growth. So I'm under the assumption that I'm going to be right on their headline growth number on Q1. That's 44% year over year growth, and accelerating and continuing to accelerate. They have a lot of tailwinds as well. They're too expensive right now, but if they are growing and it does come in at 44% year over year, and it looks like, based on a couple other things I look for in the earnings call, that they're likely to continue that this is, as Alex Karp said in his last shareholder letter, it's not just like a one-time acceleration, but it's the next leg up. He said it much better, much more cogently. But if that's the case and we see evidence of that, yeah, I'll actually probably start adding at like maybe $60 or so. Not fast, slowly. If you look at it by any multiple there, it's still expensive. But like right now, I'm not touching it. I've not bought Palantir in a long time, but it's expensive. Some of that it's just, people speculating and trading and whatnot. But a lot of it is justified too. A lot more than you guys are willing to give it credit for.
Yeah, I agree with the fact that it definitely can be larger than Salesforce, and I hope that it accelerates revenue and margin. But then that also means that the stock price has to sit still to catch up to its valuation.
Once again,
can you throw up Baba's comment, Tanner? Because I want us to start talking about this.
So once
I don't know
again,
where it is.
Can it be bigger than Salesforce? Absolutely. Right now, it's $29 billion bigger, and Salesforce is doing more than 3,000% the EBITDA and more than 1,200% the net income, and
All
almost
the text is way
1,000%
too small,
more
by
free
the way.
cash flow.
You got to bump the text up. Zoom.
Yeah. So for me, like I'm looking further out than 5 years, but in 10 years, I see it as a 4x from here, which is not 10 years, sorry, 7 years. I see it as a 4x, which people would look at me and say I'm crazy for that.
Okay,
I don't
so
think it's crazy, but
That's
it's
not
not
crazy.
like I
Roy,
see
let me
Nvidia
ask
as
you,
better. I see PayPal, frankly, as better. I'm
Roy,
still
let
holding
me ask you
Palantir.
something. So, okay, you see Palantir as a
4x.
4x in 7 years.
Hmm.
Okay. Okay. Let's say they do become over $1 trillion company. Okay.
Yeah,
In
nearly 1.2 trillion.
in 7 years from now, what are the chances? And let's go back to this one, that Palantir goes from 2.9 billion in revenue to more revenue than Salesforce or Cisco. What are the chances in 7 years? Because it would have to grow 13, 14x revenue in 7 years to get more than Salesforce,
Yeah.
probably about 17x to get to Cisco's. And neither of those companies are a 300 billion market cap. And forget price to sales on EBITDA, or even let's go with their best metric of free cash flow. They'd have to generate more than 10x the free cash flow to get to where these two companies are already generating it. So what my question is this: why are we giving Palantir a $1.2 trillion market cap just to get to where multiple companies currently are that aren't even worth $300 billion?
I mean, that's pretty fast growth on revenue.
With
Just to
fast growth, they're putting up, they'll
so
be putting up the same amount of profitability as other
in
companies.
7 years, Steve, no. If you look at the way that they cost control, I disagree with you. I don't think. I think that they're the only. Well, actually, no. I don't know about Nvidia. No company is as lean as far as Palantir is, as far as the expense portion. And it's not because they're not
What are you
reinvesting.
talking
in new
about?
products.
Adobe's got better margins.
So
Look at the
for
margins.
now,
Talk about
yeah.
lean,
But as they
89%
accelerate, you
versus
can see that
80% gross
their cost
margin.
control is kind of like Robinhood's, not to that extreme, but where 90% of their costs are fixed. It's not the same, different business and everything. But so Palantir is going to accelerate, I think, and continue to accelerate. I mean, like, I don't expect, so some people are out there saying Palantir is going to put up $1 billion this quarter. And frankly, those people, I hope they're right. And I think they're nuts because that's like 57% or something year-over-year growth. They've not done that. They're not doing that. That's really dumb. It's being priced like it's doing even more than that. I agree with you. But over 7 years, if they get to that CRM revenue, their actual free cash flow will actually be a higher yield, I expect, by that point. And also, it shows the growth, and it also shows that moat is continuing to be durable. It also shows that their TAM, that they're really, really tapping into it. And that's really what matters more to the market than anything is if you have an immense TAM, if you have a massive moat and a sticky product and a strategy that helps you get that TAM, the market will pay a very high premium for that. So I'm not going in saying Palantir is a $1 trillion company in 7 years and it's going to trade at a 10 PE ratio. Like it's not.
Right. If you are, let's just say hypothetically, private equity company, okay, you're going to go buy a company. Are you going to buy a company that is going to grow its free cash flow from 1.14 billion into 12 billion over the next 7 years and maybe generate 28 to 30 billion over those years? Or are you going to buy a company that has a track record of growing their free cash flow and is already at 12 billion and could potentially get to 15 or 16 in that time and generate 150 billion in free cash flow over those 7 years?
I think
Yeah.
it depends on who you ask, because
No,
Masayoshi Son would say,
but once again,
the
you're paying such a huge valuation. And keep in mind, I have this at a 50 billion just to show what the margin would be. This is a bigger company right now, and it generates a speckle. A speckle. They have to grow so much just to get to where these companies already are. And look at Adobe. Adobe's 162 billion, and it completely demolishes Palantir on every metric. Not to mention, Salesforce grew its revenue year over year by the amount of revenue that Palantir generates in a year. So we're talking about growth.
That's like
Palantir is the definition of a bubble. And I own a lot of it. A lot. It's the definition of a bubble.
Yeah, but I think it's absolutely ridiculous to say that it's worth like $35 or whatever. You're like, I don't know, man.
Well, okay. Let's just
I
say
don't know where you've
75
lost it
billion.
on Palantir, but you've lost it. Like if you really think that,
hold on,
has changed with the
75
company.
billion market cap, assuming all the growth that I do believe that they're going to get, puts them at a free cash flow multiple of almost 66. That is 50% more, 45% more than Nvidia.
What I don't understand, Steve, since those multiples are important to you, why were you investing in Palantir when it was?
I bought it at $10 a share.
Sure, but if it's a bubble now, the sort of undertone there, the underlying assumption is that a bubble is going to pop sooner or later. The other shoe is going to drop. It's going to fall. What's keeping you still fully invested as opposed to trimming or selling or exiting altogether?
It's a good vehicle for options at the moment.
Well, beyond that, I'm fine with a 4x in 7 years. Now, I've shared this, I think, with Amit and Tanner.
Okay,
I've shared
so
this
hold
elsewhere
on.
There are prices. I've gotten rid of some Palantir. I've taken some profits, significantly lower than they are now.
Okay,
If Palantir does
4x.
hits my numbers, 44% growth, it's amazing, and it pops up to like $220. I'm still looking at like maybe be like, well, maybe it can get to 1.3 trillion in 7 years. It's a lot less attractive there because I'm looking at like a 2.5x in 7 years. At that point, I'm going to take a lot of profits off the table. I'll still keep some, but I'll probably sell at least half.
Yeah, but people are already putting like the fair value, like this is essentially 2x their fair value. So like, where's the margin of safety on this investment if people are already pretty stretched?
Well, and let's look at what Meta is doing, because Meta would be the closest thing to Palantir 4xing of a company that's over $1 trillion. Let's look at what Meta does. Oh, 170 billion in revenue. Okay, cool. Like,
yeah, but the sheer number doesn't matter. It's the percentage.
Well, the sheer number, of course, it matters. This is how much profitability and revenue they do.
No, that's the same argument people use for like Apple and buybacks. You're like, look how big the buyback number is. It's like,
it increases EPS.
But even as
it's buyback yield that I think is more important than the buyback number.
Even as a percentage,
the market disagrees. But it should be. You're right, Tanner.
Yeah, no, I'm with you on that point, Roy. Honestly, I think that our investment styles are very overlapping. But this company is just expensive. That's the only thing that I find.
Meta has a bigger gross margin than Palantir.
Now,
I mean, look at their net income margin, and Meta at 1.5 trillion is trading at 28 times its free cash flow and 23 times its net income. So for Palantir to 4x over the next 7 years, they would be just under a market cap of what Meta is doing right now. Yet Meta is ridiculously bigger. Palantir's coming nowhere near these numbers. They could grow at 200% every year for the next 7 years and not come near these numbers. So why should they be in the same level as Meta? There's only 7 companies or 6 companies that are trillion-dollar companies, and they all have established numbers of what they're doing. Look at Google. Google is the next biggest one with Amazon. Amazon's number is going to be pretty similar to this.
So Steve, you and I are arguing from different standpoints. You're on just sheer numbers itself at all, but I'm telling you, the market puts a premium on companies that have a massive TAM, a massive moat, and a strategy that is going to get a lot more.
Meta's got a bigger TAM than Palantir, and the market's not giving it any respect for the numbers that it grew into.
It does not have that big of a.
It has 4 billion people using its products every day.
It has competition.
Look at the amount of revenue they're doing. Palantir won't get to that level of revenue in 30 years. 170 billion a year.
We'll have to see how things play out. But right now, like the most credible competition Palantir has is, other than Alex Karp saying where it's like the internal like engineering team or whatever, is Microsoft Fabric, and it's not great. It's just really not. Will there be something in the next 7 years that comes in as credible competition? There sure could. Palantir is not cheap as a service. Others are going to try. I don't know if they'll succeed or not, but
man, there sure will be.
Look,
like it's not about sure. Sure could. They're like
Tanner, hold
Salesforce
on.
was
Well-
a competition to go after,
on.
and there still were competitors that came in and
Yeah,
blew.
we just don't know if the competition will be credible or not. That's the thing.
Guys, do you want to see the results of this poll? It's going to shock you.
Oh man,
I
sure.
threw-
I don't even know what the
I-
poll was.
I throw,
Something he wrote. This is
I'll
going to be.
explain it to you. Hold on. Buy and hold only one name at these prices over the next 7 years. The options are Palantir, Nvidia, Google, and Salesforce. Palantir.
Palantir, I'm going to go nuts.
It's
Hold on. Palantir is at 31% of the vote. Nvidia is at 39%. Google's at 29%, and CRM is at 2%.
yeah, and good. Now, if you would have put SoFi, it would have been 99%.
Yeah.
So, but once again, you talk about the companies that are trillion-dollar companies. Meta is 1.5, Alphabet's 1.9, and Amazon's 2 trillion. Okay, we're not going to get into Nvidia, Microsoft, and Apple because they're 2.5 and bigger. But the market has already spoken about what has to happen to get to $1 trillion valuation. We have 6 companies that have shown what that is. Oracle is like 450 billion. Broadcom is like 600 billion. I mean, the
To be
idea
fair,
that Palantir gets to $1 trillion when Meta wasn't even $1 trillion, when it was doing 100 billion in revenue, is crazy. It's crazy.
can I say that before Nvidia was what Nvidia is today, they were a much smaller company, okay? And they were probably the fastest company to reach $1 trillion while posting financials that Steve had thought of as disgusting.
Yes.
And then the company had stayed stagnant for many quarters and allowed for triple-digit growths to make the financials add up to the valuation, actually surpass it now. That can happen to Palantir. Palantir can absolutely, in a very quick period, I mean like 18 months, very quickly catch up to its valuation and then succeed it because the forward-looking years will hold up that level of growth. That's going to be very hard. You know, very hard. And in each sort of like, what do you call it? Like industry change, there's a lot of names that come out where people think that this is the next big thing. Everyone knows Cisco obviously is probably being the biggest example of that, of saying like, the internet's the next biggest thing. This is going to be the biggest company in this industry. And they way overestimate their growth rates. The idea that Palantir is the only company, they're getting NATO contracts, everything like this, and that there's going to be no competition, I just think is ridiculous.
Well, keep in mind,
Yeah, there's none right now. And
is
that's
the perfect example because in 2000, Cisco was doing like 13 billion in revenue and several billion of net income. It traded at the levels Palantir is trading at. And 25 years later, it's 4 or 5x its revenue. It's 3 or 4x its profitability. It's generating over 12 billion in free cash flow. It's bought back more than 35% of the shares outstanding. And it is still in 25 years never gotten back to the level it traded at. Yet it has done exceptionally well, growing its top and bottom line. All I'm saying is that Palantir generates very minimal profitability compared to the market cap, and people are giving it a growth rate that they're not going to reach. And this company isn't even going to reach the numbers in 4 or 5 years that companies already are now that aren't even worth 300 billion. And it's not one company, it's multiple companies. I only put 3 examples up.
Yeah, like even if it was doubling every year in terms of revenue, right? Like
The next 3 years, it does not catch up.
32, it would still take them years and years, right? Like at the rate they're currently growing, they're going to be way overvalued 10 years from now, even.
Right.
And like, and investors buying 10 years from now are probably going to be okay with that. Like, I'm not saying it's like they're always going to buy this thing that's super richly valued because of the future that they believe that it has, and that's fine. But
that can stay forever.
It can.
Shopify has never been cheap.
Exactly. But I'm saying it's never going to be like Palantir. I don't think it's ever going to be cheap unless you see it like have a major crash. It's always going to trade at a premium.
But not this much for long. Like I think the most realistic thing is, and it could still go up quite a bit. I'm not buying it here. It's still most of my portfolio. I do have some hedges on it too, But the reality is that if it goes up a whole bunch, I'm going to start taking some more gains. If it goes down, I'm not going to be thinking, oh, it's going to go to 15 or 20 or $5. Like it's not. And I do want to have some more. I think it's a unicorn company. Yeah, it's not going to be a dividend company, even though that's the question that people always ask on earnings for some reason.
Palantir doesn't pay a dividend, therefore it's overvalued.
Exactly. Yeah, there we go. And it's way too expensive right here. So what I think will actually happen is they'll execute phenomenally. They'll continue to do so. And very likely it's going to have a blow off the top moment. It's going to come down and settle. And it may be like less than half of where it's at right now and then trade in a range for a little while. And that wouldn't bother me at all.
So Roy, for Palantir and growing at a 50% growth rate year over year on revenue, okay, for them to get to where Salesforce is currently at today would take 7.5 years.
Do you not think that Palantir could get eventually to a point where they're growing at triple digits?
No.
Look, anything's possible, but the problem I have with Palantir is there's immense competition. Nvidia did not have any competition when they achieved that. Now, people can sit there and say all day long, Palantir doesn't have competition. I know Palantir software better than a lot of people, okay?
Better than Roy?
Maybe not better than Roy, maybe not better than Minute, but I know better than most people. When you're in business, you have to make decisions on capital expenditures and outlays on software, okay? Palantir has not gotten in to a total addressable market that actually encompasses an ERP system for traditional companies. That's why they're limited in complete customers. So they're not expanding into markets that could allow them to get to 100% growth rate. They would need to be able to
I agree with Roy. Total addressable market wise, they are unbelievably large, but that's not. I think you're more looking at their serviceable addressable market, things that they actively are wanting to go after.
They would need to expand into in order to be able to hit those 100% growth rates. They would need to get into traditional ERP and go after Oracle, Workday, SAP, and Microsoft Dynamics, and ADP. Paycom, all those companies.
The problem is you're arguing what we've all agreed with, Steve, that it's expensive. It's very expensive.
Ontology solves this, guys. Okay, we already know this.
Ontology does not solve payroll, does not solve HR.
So can we talk some PayPal right quick? What do you think on PayPal, Steve?
You guys have 60 seconds. I'm putting it on the clock.
PayPal was a very good quarter. The market's wrong, and Alex Chriss needs to shift. Nobody cares about buybacks anymore. He's done buybacks in large numbers for the past couple of years. Market's not caring. And at this rate, they're going to buy back the entire company in 11 years. Take that $6 billion, do $3 billion in a dividend, $3 billion in a buyback. The dividend on their shares outstanding on $3 billion becomes 4.2%. You watch how many people start buying that with a 4.2% yield. It gets added to a lot of different ETFs and mutual funds that are dividend focused. It'll be one of the largest yielding dividend stocks from the tech sector. Otherwise, this is dead money.
I disagree with you, but I do think that a small dividend like an Nvidia dividend, and then you grow it over time, and you get serious with it in a couple of years, would probably be the thing. Wait for a position of strength. We talked about that before. What I think is interesting, in particular, and it's not just with the earnings call, like they execute on exactly what they say that they will do. I love the level of transparency. They came in, they gave a very soft guide, and I think it actually sets up things for a very nice beat in quarter two, as long as macro doesn't fall completely to pieces. But what's even more interesting to me is in fintech and in commerce right now, like there's two really big thrusts, and one of those is stable coins, and the other is AI, specifically agentic AI. And PayPal has been talking about those actually earlier than pretty much most of the players that are now starting to talk about it over the last couple of quarters. And it's like, what I love, and the market doesn't see this, they don't care right now, but at some point it is going to get the market's attention, because I mean, they could continue to put points on the board, is they had this idea that PayPal, I think 2.5, 3 years ago, it's a dying company and nobody uses it. Well, that was wrong at the time, but they just set an all-time high of active users. This is a company that doesn't innovate anymore. Well, they are ahead of all these companies with, I think, guest checkout, not sure, stablecoin for sure, and also with agentic AI. And just like on and on, like it's heavily siloed. The competition is killing it. All these different things. There is some slowdown that's very deliberate that a lot of people don't understand with Braintree and the top line revenue. Top line revenue stinks. It's not very good. And there's one thing in there that I didn't think was very exciting, but everything else, like the margins, they're like, oh, the margins are going to go to zero. Well, no, that's not the case. It's the opposite. Or Venmo. Venmo is getting eaten alive by all this competition, like Zelle. And no, it's actually outperforming every peer-to-peer company. Oh, they can't get into omnichannel. Wrong. They have 3 million debit cards that they've issued in the last like 3 months that are used that actually bring lift. They have a real flywheel for one. It's like, oh my goodness, dude. It's slow, and I get it. It's taking a while to turn, and I get it. But man, this is not the same PayPal as it was 2.5 years ago, even though the stock market doesn't realize it.
Someone also, I know we're FinTech Fridays, but people are asking about Tevis's favorite hymns. Do you guys use any hymns products? Yes, we're all on the products. So Roy actually is on testosterone replacement. That's why he's so fired up today. Tevis is, or sorry, myself, I'm doing the hair stuff, trying to fill that in. Steve, ED, it's age. And Tevis is actually on estrogen replacement. That's why he's got the big boobies. So,
Okay.
I don't think any of us use any HIMS products, but they do have earnings on Monday alongside Palantir.
Yeah, go ahead.
So yeah, just kind of as a bonus, and I think we'll skip over Robinhood earnings. We all know it was really good; they're awesome. But yeah, HIMS. So this is the least important quarter of the year for HIMS, just because they have GLP-1s and the full quarter of revenue there. Guidance will be interesting. They guided very aggressively on weight loss, so it is important to see how they're doing in the other weight loss products. They also had an important partnership with Novo Nordisk, which is the reason why it went up to like $40. Tanner, did you buy HIMS when Amit was like, hey, why don't you trust your friend and buy 100 shares at like 26?
No, I did not. I'm sticking with my 3 or 4 shares, whatever I have.
And Amit literally told him, I don't know if you saw this, Tevis, but he's like, hey, you should buy 100 shares. And Tanner's like, yeah, I probably should. The next day, it went up to $40. Amit sold. Maybe it's 2 days later.
I wouldn't even have had time to buy it.
HIMS is up like 45% this week.
Yeah.
They did a reverse block.
Yeah.
It's got nothing on Palantir.
It's an exciting company. There are some bear cases there, but like the Novo Nordisk, we'll have to see like what some of the details are, but it takes away a lot of the regulatory risk, which is a really good thing for HIMS.
But yeah, and then like HIMS is already advertising to their clientele that they're going to keep doing the semaglutide uninterrupted at all. That's going to be massive for them because their forecast for the weight loss segment was the biggest reason why the market was selling them off because of the May 22nd cutoff for semaglutide. But now with the Novo partnership, they're going to be able to continue that for the remainder of the year. And one thing to expect for HIMS on Monday is a huge guidance raise as a result of that deal, because it's something that they didn't have before, and they're doing a stupid amount of money from that segment alone.
Yeah.
Sorry, I read a funny comment. Sammy Tummy is sentencing us to death.
Yeah, with HIMS though, I need to take a look and see what the market does on open on Monday. But Tevis, I'm going to do what we said that we wouldn't do, and I'm going to sell some covered calls, probably at the highest possible strike. But I'm comfortable getting rid of HIMS at that price too. So yeah, I think it's 55s or 60s.
Look, I did you all a favor, and I'll break it here. And I posted about this on Twitter this week.
Oh my gosh.
Is I sold 46s for Friday. So you're welcome. We're absolutely 1,010% guaranteed. Tevis stamp of approval, crossing 46 on HIMS this week. Not financial advice, but
I was going to say with an asterisk.
Yeah,
This is an entertainment show. Definitely not guaranteed.
not guaranteed, but I'd bet on it, and I have.
Did you do that deliberately?
What?
Did you do that deliberately, like right at the end of Friday, or is it just run up on you?
No, I wrote them, I think, on Wednesday, covered calls. And no, it was a day when they were up like 13%, and then they were up again 8% maybe today or yesterday. So it's fine, but I do it for you. I do it for you guys. $46 this Friday.
Right. So
Very
I should
generous.
be 48 cents.
Yeah.
Roy, I have a question for you.
It's still overvalued.
No.
Palantir.
No.
Costco.
In all seriousness, I have a question for you about Palantir. So,
yeah, really?
Did you look at their interest income versus what their operational income is?
Are you looking at quarter 1 or not?
I can look at the entire year of Q4 because in Q4,
Not as useful.
okay, in Q4 they generate 11.4 million in income from operations and 54.7 million in interest income off their cash. That's not great. What happens when the Fed starts cutting?
Not too much. Like their revenue is growing so fast that they're fine. Like that's if this was a company that it was just all about the growth of that, which some bears have said, they're just wrong. They're silly. I've seen bears also. I saw somebody in the comments say Palantir makes less in revenue than SoFi. I don't know what they're looking at, but it's not Palantir and SoFi.
So in 2024, Palantir's operations generated 310.4 million. Okay, that's a real number. Its cash position produced 196.8 million, almost 2/3 of what it did in operations from income. So income from operations, it's late, but the bottom line is the Fed is expected to cut 3 to 4 times this year, and by the end of next year, cut by 150 bips. Those are the most likely scenarios from CME Group. When that happens, Palantir's cash pile or income from cash is going to drop dramatically. So even if their revenue increases enough to offset that, their profitability is not going to grow much because of the depreciating value that they're generating on cash. That's a problem.
No, not really. I mean, it's a small
How is that
headwind.
not really? It's
I
numbers.
doubt that until the Fed actually cuts 3 or 4 times, we'll see. But this was a bear argument, Steve. Go back to when Chris Patel sold Palantir. He made the same observation, I believe, maybe 2.5 years ago, and yet we're still here. So I'm not saying it's not a headwind. It is a small headwind, but what I actually care about is not the income that they're making from interest, because that's not the story. It's just not. Just like with SoFi, I've written off the tech platform. It's doing what it's doing. I'm not expecting anything more of it. If there's upside, then great. That's not the story with SoFi. It's a loan platform business. It's financial services.
I cannot wait till Monday afternoon. Like, I can't believe I'm going to say this. Palantir is either going to 155 or 75 on Monday. There's no way it stays at 123.
Bro, I will bet you money that it's going to go to 155 over 75. Have you seen the Palantir investor base?
I'm not saying which way it's going to go. I'm just saying there's no way it stays at 123. This is either going to 155 or 75.
Yeah, that it's impossible to predict the price action. Like I gave pretty generous, but I think fairly likely like over 40% year-over-year revenue growth, which is insane for Q1, and it should go down. It should go down on that, and it probably won't, just because it smashes expectations. Now, if the crazy Palantir bulls that say it's going to go over $1 billion when they're expecting like mid 800s as far as $1 million of revenue, that's 57% year-over-year revenue growth. Yeah, the stock is going up, even though it still should go down based on the multiples, even though they fantastically outperformed. And they're not doing that anyway. But
if they put up 45% growth rate, this goes to 150 automatically.
Yeah, I think 44, but yeah, like
I'm not like trolling or anything. I truly believe it will go to 150 if they put a 45% or plus growth rate. And if they come out and say that 2025 will exceed 40%, I think that this continues to go up. And I don't think any type of logic will bring it down.
Yeah,
My
and
question:
I've got
Who
to
the
figure
hell?
out where I want to sell more.
Well,
Because
and here's
I
my question: Who the hell is buying here? That's what's even crazier to me. Like everybody that I know has a cost basis of under 20.
at some of its institutions. I do think in the hundreds, in the low hundreds. I think a lot of people that are connected to the government that are seeing what's happening with Palantir. I think that they were buyers, but like even like right now, it makes no sense. It's a mistake in like shorting a company just based on valuation because you never know what's going to happen, especially when it's a quality
Oh
company.
yeah, I mean, if you had
But
short Nvidia, you would have got killed.
but man, like I wouldn't buy here. I'm not going to. And when I sell, there's tax ramifications too. So like that's a factor that I'm also.
And I think that's a big factor why people aren't selling. 'Cause I think a lot of people hold it in traditional brokerage accounts. People are up 10, 12x, and there are huge tax implications. And I think that's a big factor why people aren't selling.
But you know what, though? If you rotated that into Nvidia, that would be such an amazing trade. And both of you guys would agree with me, and you guys don't do it.
I've been buying a lot of Nvidia.
I mean, like some of my Palantir proceeds probably filtered into Nvidia directly because
I'll tell you what, I am going to roll into Nvidia. Once my Tesla cover calls are gone, I'm going to get out and put in Nvidia, Tanner.
But no, like there's absolutely price levels, and we're not that far away where I start taking profits on Palantir again, and I'm fine doing that. And I'm also fine with it going the other way. It can go back to 60, 55 bucks. I'm good with that. That's a big swing. It's volatile, although it is boring as far as stock price action compared to HIMS.
Yeah.
I don't understand why you're not in HIMS, Steve. It's absolutely a no-brainer for you to be in this company. And same with you, Tanner. Like you guys are just letting your ego blind you. Read the financials. Look at the actual numbers that they're putting up. It's a no-brainer.
I've never really looked into them. I just don't. I feel like companies like Regeneron are going to end up eating their lunch.
Just do yourself a favor and read up into it. Like Nova would not be partnering with them if there was nothing there, and Nova is not going to sue a company that they're partnering with.
Yeah, all my money's in Regeneron. No,
Tanner probably doesn't even know what Regeneron is.
I have no fucking clue.
It's a $60 billion.
There is no investor on this planet, Steve, that invests in Joby and Regeneron in the same portfolio. Okay, those are antithetical things.
It's a $60 billion biotech. They're working on some pretty crazy drugs right now.
Yeah, I've heard of the name, but that's it.
But that's the thing, though. I don't know anything about the industry, so I don't know if Regeneron's eating HIM's lunch. I've got no clue. So, what would I rather do? Learn an entire new industry so I can get some dick pill portfolio selection?
You have more YouTube content.
Maybe, but I think my Nvidia content is fine. Nvidia is freaking sweet, and I'm really enjoying trying to get that to 50% of my portfolio.
Yeah. I mean, the three companies right now that are grossly undervalued are Nvidia, Alphabet, and Meta. Grossly undervalued.
I will tell you right now that HIMS will make a new all-time high this year. Their previous was $73. They will beat that this year. I'm telling you, it's happening.
I hope it works out.
It's going to work out for you too, baby. It's your Christmas present, not mine.
I was going to say.
Dude,
and then we all win because then I get to set the terms and conditions on this silly gift thing. Although if Chris gets it, then that's fine too.
Well, I already said, Roy, that next year you actually have to own the company to be able to gift it.
Yeah, we'll do that for sure if I win. Yeah.
None of this happy horse shit about joke gifts.
Yeah.
All right, I'm looking at him right now. There's nothing that looks interesting.
Okay.
Someone in the chat said, Tanner, what price are you buying Nvidia? This price.
This price, absolutely this price.
I actually bought
anything under 130.
I bought some today. I was on the phone with Tanner, and he was like, I'm thinking about going all in on Nvidia. And I was like, you know what? I'll just buy some. And I posted about it.
Yeah, it wasn't my exact words, but yeah. So
have you looked at how cheap Nvidia is right now?
So my video tomorrow, Steve, please, for the love of God, do not spoil this.
I don't know what you're talking about.
I know, but whenever I start saying more, you are going to know what I'm talking about, and I need you to not say anything.
All right, I won't say anything.
Thank you. I have just rotated out one of my largest positions, and not SoFi, but no more of that.
He sold Nvidia for AMD,
and I want to put it all into Nvidia. And
don't listen to him, guys. It's the opposite. He sold Nvidia, and it's all in Njobi.
All I will tell you is I know what company it is, and it was a great move.
Yeah.
Everyone I've talked to said it's a great move. Every single person.
It is.
You know,
I thought about doing it too.
And this is what I love about the investor community that we've created. I actually feel like we have such great minds in this thing. Even not, I don't mean just in the four of us, but I mean as an extended group of investors. I love that I can pick up the phone and I can call a Chris Patel or a Steven or an Amit or a Tevis or a Roy, and just pick people's brains on some ideas that I'm thinking about. And I actually do really trust their opinions. And it's a lot of fun.
Share my screen. If you're not bullish on this right now with Nvidia, you're crazy. Less than 18 times 2027 earnings, 47% earnings growth from the end of 25 into 27. I mean, this Alphabet and Meta are you buy all day at these levels.
And
it's incredible. Right?
Just kidding.
Like it is incredible. Even Amazon. Think about it. Amazon at 20 times 2027 earnings with 48% growth.
But here, are you taking 2027 Wall Street consensus?
I'm taking the consensus from 30 to 40 analysts that has on Seeking Alpha.
Yeah.
I'm making up numbers.
Sure. For which they've revised upwards every quarter.
I revised these today. So half of these companies have already reported and the numbers changed.
No, all I'm saying is Nvidia specifically, I actually think has a lower forward PE for 2027 whenever we get there.
And I will be updating it also. I'm just saying, based on today's numbers, this is so drastically undervalued for the amount of growth that we're going to get that you're paying 26 times right now. So I'm going to go up to a bigger one. And here's my big gripe. Why on earth would anybody buy Walmart?
Agreed.
With 25% earnings growth at 37 times this year and 30 times 2027 when you can buy Nvidia at 17 times?
Walmart ontology
or Amazon.
Why is anybody buying Procter & Gamble or Coca-Cola over Amazon or Nvidia? Like it doesn't make sense.
Coca-Cola just signed a NATO contract.
Yeah, back at the very beginning of the bull market, large cap tech outperformed for a long time, and actually, frankly, for a lot of these, not all, but a lot of the companies, valuations got a little stretched, and then we've seen, is it like 6 quarters now that large cap tech is largely just flat?
I mean, Roy, look at this. Exceptions. Look at how disrespected PayPal is, trading like Altria.
Yeah,
how disrespected is that?
And just like with Nvidia, I think the assumptions are so soft and so easy to beat going in. So,
but I mean, in all seriousness, we're really gonna pay 45 times for Costco with 22% growth. Like, why would you pay 45 times for Costco's 2027 earnings with 22% growth? And you can buy PayPal at less than 11 times for more growth.
Mm-hmm.
Like everybody wants to talk about growth. That's all I ever hear with defending Palantir or SoFi or whatever. Well, how come Costco and Walmart are trading at these levels with less growth than all these great companies that have balance sheets that completely dwarf them or profitability that completely dwarfs them? The market is broken right now.
Agreed. And I think the same with SoFi, but you guys say, oh, well, that part doesn't matter.
I think this is the longest ever Friday podcast that we've done. It's 2 hours. I don't think we've actually.
When you put the after hours together, it's around the same time.
I know, but I'm saying like just this episode without after hours. I think that's the longest one ever.
Also, yeah, I don't think people realize like how long some of the we've had episodes of the SoFi Weekly After Hours that are longer than our actual show.
Yes.
Yeah. Oh yeah.
So it is actually a lot of fun usually. So, and this is the type of content that you get: a lot of bickering, a lot of fighting, some jokes.
Yeah, I will tell you, we don't talk about Meta. I think Meta is the sleeper that people are looking at the share price at 600 and are missing out on an opportunity
The
because
sleeper
eventually he's going to
trillion
do.
dollar plus companies, eh?
Dude, it
And
actually grew way more than I thought they would
dude,
grow when they reported.
he came out with such a gigantic beat on the bottom line. And this is a company he's going to split the shares at some point. Don't forget, Amazon and Alphabet both split their shares. Zuck hasn't split the shares yet. If he does a 10-for-1 split and that becomes a company that's trading at 58 bucks, watch how many people watch the volume go sky high. But he is hell bent on AR and VR glasses because he pays such a large vig to Apple and Alphabet for the ecosystem of the App Store. If he's correct on this, he's going to own the entire, not just hardware, but the entire software also. And it's going to be a free fall of free cash flow and net income. Not to mention, they're already generating ridiculous levels right now. But that is the sleeper stock people are not getting excited about. And it's trading at freaking less than 18 times 2027 earnings. It's crazy.
Yeah, I just can't earn it. I can't own it at all. I don't like the social media aspect of what they do. I think it's damaging for society, and I'd almost rather own Philip Morris, even though it's a lot less exciting. But I agree with you. I think Zuck is a top 10 CEO.
You
Meta
would
is
not
a
rather own
incredible
Philip
organization.
Morris.
Just about. Like, it's just.
I mean, take it from me because I own Altria and Meta. Trust me, you don't want to own a cigarette company over Meta, and I own
No.
both.
I'm just saying in terms of, like, there are not many, but there are a few stocks where I'm like, I don't feel comfortable owning or supporting that. So
And,
That's fair.
listen, I get that, and I respect that. All I'm saying is Meta, by the numbers, is a steal, and they are a first mover in what could be the biggest computing platform we've seen.
Or you can play Nvidia and have essentially exposure to every technological advancement.
Nvidia is an amazing buy right here, in my opinion. Amazing.
yes.
The world's going to the cloud, not on-prem.
Think about every big tech company that we care about with CapEx reported. And what did they all do? They all maintained, and Zuck increased his spend.
Do you guys want to play for autonomous vehicles, robotics, cloud, artificial intelligence, more digital use just in general?
It's called Nvidia.
Yep.
And don't forget software services.
Yeah, you could also play it through different cloud providers as well. I think Amazon is definitely one that you could find advantages on: robotics, artificial intelligence, autonomous vehicles, cloud. Like there are a couple, but Nvidia is pretty unique.
I mean, think about the fact that Nvidia is at the point where they're selling so many chips and Amazon can't get enough. Jassy said on the conference call they cannot keep up with demand on AI.
So let me ask you guys about that, because we're talking NVIDIA and Amazon. Are you concerned at all by Trainium, the CPUs that Amazon's making and trying to market for data center?
I don't think it's going to impact NVIDIA. I think it's just going to shift workloads. They're still going to need all the NVIDIA chips for other things. I think it's more for from what I understand, their cloud services and trying to shift workloads in generative AI, but they still need the NVIDIA stuff for training and inference.
Yeah, custom silicon has never really caught up. I'm not going to bet on it going forward. By the time that comes out, and people are excited about Trainium 2 or whatever's next after that, Vera Rubin will be right behind, and then everyone's going to look at that as being the next biggest thing. So, in my opinion, I don't see companies catching up right now.
Yeah, no, I agree. I was just curious how you guys saw it. I mean, you can see it in the fact that Amazon is buying from NVIDIA. If their Trainium was like that good, it would be going the other direction.
Guys, Apple is buying from NVIDIA now. Apple.
Yeah.
NVIDIA can't make enough chips.
No, literally they can't.
They cannot make enough chips.
But that allows them to sell really high margins.
Yeah, and the big thing with NVIDIA is that you don't have to replace the entire server. You can just mix and match and pull one hopper out and start adding new chips to it, and they all work together. That's the big thing. That's why AMD is not going to get into the space the way NVIDIA is.
Dude, we're at 2 hours and 4 minutes. We want to wrap?
Yeah. Or I'm going to fall asleep.
Ladies and gentlemen, thank you all so much for watching. Really do appreciate you watching the first episode that started on May 2nd and went into May 3rd. Thank you all so much for watching. Really do appreciate your time. But bye for now.